everyone, it's Sarah and Amy, and today we're going to talk to you about the different ways to lower your interest rate when you're purchasing a home.
Yes, so there is a lot of talk that you might have heard people use some abbreviations for a 2-1 buy down, temporary buy down, permanent buy down, and they are all similar but have different requirements for each. So Amy recently had a client that was receiving some money from the seller. So we call those concessions. That money can be used to temporarily buy down your rate for 1 year, 2 years, or 3 years. On top of that, you as the consumer can decide to also pay extra money to permanently buy down your interest rate on top of the temporary buy down or by itself. When we talk about that permanent buy down, we really look at the numbers to make sure on how long you plan to be in the house, how much it costs, how much the monthly savings are, and does it actually make sense to spend that money or to hold that money in your pocket. But a lot of people are very rate focused right now and payment focused right now because of where our values are in the state of Colorado and really across the nation. They're all elevated. So in order to make that payment a little bit more tolerable for your everyday living and incorporating it into everything, buying down the interest rate yourself on top of possibly using seller concessions for that could be a really great combination, or we can look at doing them completely individually as well.
Right. So it was really important for me with this client that I was working with to make sure that, when you do a 1, 2, 3 year buy down, what that means is that you reduce it temporarily, your interest rate, but then it will go back to whatever that locked in rate was. So if it's say 7% interest rate, you start at 5, then it goes to 6, and then it goes to 7.
If that was a 2-year
buy down. If it was a 2-year buy down. Mm-hmm. So then at that end of the 2 years, he's now at 7%. And so my concern was, what is that going to look like for him in 2 years? And so could we just do a permanent buy down, mm-hmm. right?
Yeah.
Take the money and bring it down to 6.5, maybe? Say 6.5. And that is his interest rate for 30 years. And then when interest rates improve, then you can just refinance, and then you can get a lower rate if that happens.
Yeah. So the mindset when they laid out these temporary buy downs is that the market has been elevated, hopefully for a short period of time, no more than 1, 2, or 3 years, depending upon when the person gets into the loan, and we would be able to refinance to a lower interest rate, during that time period, so you don't have to have the full rate at the end of the year, 2 years, or 3 years. Since rates have been a little bit elevated for longer than I think we all expected, doing a permanent buy down has been in a lot more of my conversations and a little bit more appealing for some consumers.
Right. So just if you can't tell already, we work really hard at trying to make it work for the buyer. We want to make sure that when we look in the future, we don't just look right now and what we can get you into right now. We want to make sure that it's sustainable. So if you have any questions about what we were talking about, if you need us to go more in depth with you, or if you have thoughts, questions, concerns, please reach out to us. You know where we are.